I'm reading out the the reference guide to regulatory compliance published by the ABA. I'm in subsection 2, credit, and I've gotten up to lending limits on page 209. What I found is that I have to reread everything because I wasn't reading it loud enough before, so now I'm just going to call it out at the top of my lungs here. Lending limits is apparently issued by the OCC. It's in Title 12 of the Code of Federal Regulations, Chapter 32, and it's with regard to national banks and savings associations. Limits on loans to any one borrower have been a part of the national banking laws for many years. The purpose of lending limits is to prevent a bank from placing too much of its capital in loans to any one borrower. Placing limits on loans to a single borrower safeguards depositors' funds in the bank by spreading the bank's loans among a larger group of borrowers. In 1982, new lending limits were imposed by a Garn Street Germain Depository Institution Act. The Office of the Comptroller of the Currency has issued regulations to implement the requirements of this act. The Office of Thrift Supervision had also published rules that adopted the national bank limits with only slight changes. In 1995, the OCC revised its lending limit regulation for the purpose of simplifying compliance by clarifying the rules and requiring less frequent calculation of a bank's lending limit. In 2001, the OCC extended a pilot program that temporarily allowed for a larger lending limit for residential real estate loans and small farm loans. The program was made permanent in 2007. In 2010, the passage of the Dodd-Frank Act, with the passage of the Dodd-Frank Act, the OTS was integrated into the OCC. This integration was effective in 2011, and the OCC republished the former OTS lending limit rule to bring it within the regulatory jurisdiction. In 2012, the OCC issued an interim final rule limiting the separate lending limit regulation for savings associations and implementing a provision of the Dodd-Frank Act that requires that derivatives, purchase agreements, reverse purchase agreements, securities lending transactions, and securities borrowing transactions to the coverage of the lending limit rule. Although the expansion of the regulation to cover derivatives and other securities-related transactions was effective as of July 21st of 2011, financial institutions are exempt from including these newly added transactions in their overall lending limit restrictions until January 1st of 2013. The subsection 1, National Bank Lending Limits, describing coverage, here on page 209 reads that loans made by any national bank or savings association of any of their domestic operating subsidiaries covered under the bank lending limits are not covered under the national bank lending limits are loans made by a national bank, savings association, or any affiliate subsidiary or EDGE Act or Agreement Corp subsidiary. And loans made to executive officers, directors, or principal shareholders are also subject to Reg O limitations. Okay, I'm sorry. Point 2 was supposed to say that the bank making loans to another bank isn't covered. Sorry, I got that confused. But loans to insiders are covered. Covered loans and extensions of credit. Any direct or indirect advance of funds to or on behalf of a borrower where the borrower is obligated to repay such advance or it is repayable from specific property pledged against the obligation. That would be a covered loan or extension of credit. Further, a maker's or endorser's obligation arising from the bank's discount of commercial paper is considered a covered loan or extension of credit. A purchase of securities subject to the agreement that the seller will repurchase the securities at the end of the stated period is a covered loan or extension of credit, as is a purchase of third-party paper subject to the agreement that the seller will purchase the third-party paper subject to an agreement that the seller will repurchase the paper on default or at the end of the stated period. The loan is the total unpaid balance of the paper owned by the bank less the dealer reserves. Overdrafts are included as extensions of credit or loans, and the sale of federal funds with a maturity of more than 1 business day, except federal funds sold under a continuing contract. Charge-off loans are included unless they are unenforceable by reason of discharge in bankruptcy, they are no longer legally enforceable because of the expiration date of the statute of limitations, or that they are no longer enforceable for other reasons provided that documentation maintained by the bank supports the unenforceability. The bank's contractual commitment to advance funds, including a commitment to advance funds on the default of a customer, guarantee or act as surety for a customer, advance funds under a qualifying commitment to lend, or advance funds under a standby letter of credit, a put, or a similar arrangement. Defined definition does not include a commercial letter or of credit. For God's sake. I laugh here because, we're talking about lending limits, as a amount to one borrower that has to be limited. And it's just comical that, we're including in that number amounts being charged off due to bankruptcy. Charge-off loans unless they're being charged off due to bankruptcy. And it's like if I have $500,000 extended already to a borrower that's being charged off, then, what do I care what the lending limits are, because I really don't think I'm going to extend them another $500,000. But, that's just why I laugh. But we're talking about loans and extensions of credit, including the bank's contractual commitment to advance funds, which would be done under an overdraft, would be done as a guarantee or act as surety for a customer, such as the standby letter of credit, put, or similar arrangement, or commercial letter of credit, and or advance of funds under a qualifying commitment to lend, which I guess is more often taking place in the commercial division of the bank. So, moving on, other loans and extensions of credit that are covered under lending limits is derivative transactions, including any transaction that is a contract, agreement, swap, warrant, note, or option that is based on the value of any interest in any quantitative measure or an occurrence of any event related to or on more commodities, securities, currencies, interest rates, indices, or other assets, and securities financing transactions, including repurchase arrangement, reverse repurchase arrangement, securities lending transaction, or securities borrowing transaction. Also included as a loan or an extension of credit here. Exemptions, however, to lending limits include 1 through 6. 1 being additional funds advanced for the benefit of a borrower by a bank for payment of taxes, insurance, utilities, security, and maintenance, and operating expenses necessary to preserve the value of real property securing the loan. Accrued and discounted interest on an existing loan. Finance sales of the bank's own assets, including other real estate owned OREO, if the financing does not put the bank in a worse position. A renewal or restructuring of a loan as a new loan following reasonable efforts by the bank to bring the loan into conformance with the lending limit rules. Amounts paid against uncollected funds in the normal process of collection, and amounts paid against uncollected funds in the normal process of collection. Portions of loans sold as participation on a non-recourse basis, provided the sale requires a pro rata sharing of the credit risk proportionate to the respective interests of the lenders. Participations will not be considered to be loans subject to the lending limits if, when the originating bank funds the entire loan, it receives funding from the participating banks before the close of the next business day. And if the loan is not funded by the next business day, it will be considered to be a loan from the originating bank to the borrowers. It will be considered to be non-conforming, but will not be a violation if the originating bank had a valid and unconditional participation agreement with the participating bank that was sufficient to reduce the loan to within the originating bank's lending limit, And the participating bank reconfirmed its participation, and the originating bank had no knowledge of the information that would permit the participant to withhold its participation, and the participation was to be funded by close of business on the originating bank's next business day. Other loans not subject to the lending limit rules are loans arising from the discount of commercial paper, bankers' acceptances, loans secured by U.S. obligations, loans to or guaranteed by a federal agency, loans to or guaranteed by general obligations of a state or political subdivision, loans secured by segregated deposit accounts, loans to financial institutions, loans to the Student Loan Marketing Association, loans to industrial development authorities, and loans to leasing companies. So all of those are other loans not subject to the lending limit rules. But I'm going to go a little bit further into these. Probably going to end with that in this session. Loans arising from the discount of commercial paper applies to negotiable commercial or business paper evidencing an obligation to the person negotiating the paper. Loans arising from the discount of commercial paper must be given in payment for commodities purchased for resale, fabrication of a product, or any other business purpose, and must bear the full recourse against the owner, and if principal or interest is not paid, the exception is removed, and no additional loans can be made to the borrower unless they are within the lending limits. Bankers' acceptances is the second type of loan not subject to the lending limit rules, and banks may purchase eligible acceptances without a lending limit. The following will not be covered under this exemption. That's a bank's acceptance of drafts ineligible for rediscount, a bank's purchase of ineligible acceptances created by other banks, and a bank holding its own acceptances. Third type of loan not subject to the lending limit rules is loan secured by U.S. obligation, which includes loans that are fully secured by bonds, notes, certificates of indebtedness, and U.S. Treasury bills or similar obligations fully guaranteed by the United States. Includes loans backed by the full faith and credit of the United States, and the bank must perfect a security interest in the collateral. If value falls, bank has 30 days to bring loan into conformity with the regulation. Okay. Loans to or guaranteed by a federal agency. It says here that the guarantee must be payable in cash or equivalent within 60 days of demand, and the commitment must be unconditional. That is, factors beyond the bank's control cannot negate the guarantee or commitment. Loans to or guaranteed by general obligations of state or political subdivision is another loan not subject to the lending limit rules, and that is more specifically loans guaranteed by general obligations of state or political subdivision must constitute a general obligation of the state or political subdivision, and the bank must obtain an opinion of counsel that the loan is valid and enforceable general obligation of the borrower, or, if applicable, that the guarantee agreement by the state or political subdivision is valid and enforceable. And I feel like this is just like another way of saying like municipal bonds. You know, like what we're really saying is like the bank's holdings are not considered under lending limits because the borrower isn't really the U.S. government or the state or political subdivision or the federal agency that's buying our mortgage securities. So all of this kind of goes without saying. It's really logical here. Loans secured by segregated deposit accounts must perfect security interest in account under state law. If deposit matures before loan maturity, bank must perfect procedures to prevent release of the security without the lending bank's prior consent, and deposits in other currencies must be freely convertible to U.S. dollars, and bank must establish procedures to revalue foreign currency deposits to ensure that the loans remain fully secured. Loans to financial institutions are not included, once again, but they must be approved by the Federal Banking Agency and used in emergency situations only. Loans to security loan market associations, as I said before, loans to industrial development authorities that must be created to construct a lease or plant facility, including a healthcare facility or industrial occupant. Bank must evaluate the creditworthiness of the industrial occupant. The authority's liability on the loan must be limited to its interest in the facility, and the authority's interest in the facility must be assigned to the bank. And the industrial occupant's lease payments are assigned and paid directly to the bank. Running out of time here to go over loans to leasing companies.